I knew it was somewhere irreplaceable. And all property is unique, but this is the reason why. Buying a rental property in America is no longer profitable because the current mortgage rate of 6.1% on average is significantly higher than the profit cap rate of 4.4% of rentals. For those of you listening to the show, you don't know what cap rate is. We've covered that on previous shows, but what I will tell you, it's a capitalization rate. It's a way to compare like investments to like investments. I'm not a fan of it. I like getting to look at properties from a cash on cash return. How much money am I putting in? How much money is it giving me back every single year? But a lot of people use the capitalization rate as a way to do that. And you know what? That's totally fine. A lot of real estate investors, that's just a preferred metric. All good. What they're basically saying is you're going to get, on average, about a 4.4% return on most rentals that you buy. You can get more than that if you put more money down in theory, but incrementally more, and that's kind of where you're going to wind up. It's just how much cash you're going to put into it to get a return, and that's what you're probably going to get. So if the average mortgage rate is 6.1% and you're getting a 4.4% cap rate on a property, that means the bank is making 1.7% more on that property every single month than you are owning it. And I had this conversation multiple times with investors over the years, where I would call somebody up and say, hey, man, the cap rate on this property is 2%. And your rate is 4%. And they go, yeah. And I go, okay, just to be clear here, I want you to understand, if you have a cap rate of 2%, your return on this property is 2% a month. But you're paying me interest of 4% a month. If you're okay making 2% a month on this, that's all good. But I want you to know, you buying this property with our loan is paying me twice as much as it's paying you to own it. Think that through. It's more profitable for you to own that property for the bank than it is for you as the owner. Now, that doesn't include interest. It doesn't include equity increase over time if you ever sold it. But most of these property owners aren't going to sell it. They're going to keep it for as long as they can. Particularly in California, where you have Prop 13, which keeps your taxes down so long as you don't change title. So there's a lot of reasons why that's a strange set of circumstances. But avid, diehard real estate investors, they don't care. Get cash flowing property as long as it pays for everything, as long as it's cash flow positive. You're building that equity. Do it. Rents tend to go up over time. You're going to make more money. You're going to improve on that cap rate. It's a starting point. Get your foot in the door. And most real estate investors feel that way. And you know what? I kind of am in that camp. I don't disagree with it. But I knew the property that I sold had a 12% return cash on cash for me. And I know I'll never get that anytime soon. This means that any investor who uses debt to finance their purchase is likely losing money on cash from day one. So that's a pretty powerful statement. Note how from 2012 to 2022, so over the course of 10 years, the opposite was true. Cap rates were higher than mortgage interest, which is why so many people piled in the single-family rentals. This is no longer the case. So on one hand, single-family rentals wound up being wildly profitable for a 10-year period. I bought a lot in that same period myself. They are no longer profitable. For those of you saying, oh, institutional investors are carrying the market, you're not going to see that anymore, okay? They're not going to be buying in your market being competitive. So what does that mean for the housing market? This is one of those proof of concept things. This is one of those proof of theory things, right? We've often talked about how institutional investors owning significant chunks of real estate in the market was actually somewhat overblown. And we talked about the data and how it was really such a small sliver of the American single-family home market was owned by institutional investors. And most of it was owned by mom-and-pop rental owners or owner-occupied properties, right? Well, if those transactions are now out of the market because it's no longer economically viable, because guess what? The rates just don't make sense, like I just read to you. That means institutional investors are out of the market, which does explain why you're seeing transactional volume falling off a cliff at near 7% year over year. Because guess what? The institutional investors are now out of the market. It's just the consumers that are left. Is that a good thing? Is it a bad thing? Well, those of you who say, oh, these big companies are the worst and they're screwing up the market and they're driving home values up. Well, here's your chance. Has it impacted home values? Have they come down yet? Not really. Not yet. It's early. I'll give you that. It's early, but it's not looking quite like that was the case based on the data. So I am going to talk now about breaking down interest rates in the mortgage market. We're going to talk about this bond conversation that I've been foreshadowing too. And there's a lot here, okay? I'm going to try to cover as much of it as simply as possible. If there's anything here that you hear and you're confused about or you want me to elaborate on, shoot me a DM. I'll try to respond to everybody as much as I can. I've been a little slow on Instagram lately, but I will get back to you. You can also find our media at Higher Standard Podcast email address on our YouTube channel. And if Saied were here, he'd tell you to go on over there, click subscribe, like, share with your friends. If you don't follow us, follow us. You haven't left us a review? Leave us an honest 5-star review because those are the only honest ones. And as Saied would say, do the moist, goody good. Nasty sassafras stuff. I hate saying that. Ugh, makes me sound gross. All right, let's talk about interest rates. They are actually up since the Fed cut rates last week. What? They're up? Yeah, they went up, not down. But Chris, they cut 50 basis points. What the hell happened? Well, just like we told you on the show for literally years, you have this inverted yield curve. The 2-year treasuries, which is the near-term treasury, because they mature in 2 years, versus the 10-year treasuries, which mature over a longer period of time. Generally speaking, there's more confidence in the economy in the long term than there is in the near term. So those rates are normally higher. They yield better returns than the short-term ones, the near-term ones, the 3-month and the 2-year. Well, for the last several, trailing, well, frankly, almost 2 years now, it's been an inverted yield curve, and you've had the 2-year and the 3-year month treasuries paying more than the 10-year did. We knew there was only a couple ways this could resolve itself. The 10-year treasury would rise above both. The other ones would drop down, be a combination of both. And you know what? In 2 of those 3 scenarios, that puts upward pressure on the 10-year treasury. 10-year treasury is the closest analog, the closest way we have of telling where mortgage rates are going to go because it kind of tracks where mortgage rates are. Mortgage rates track, where the 10-year treasuries are. So we knew the 10-year treasury was going to rise. And an interesting phenomenon, ahead of rate cuts, the bond market typically prices in a cut. And whoa, hey, we got a 50 basis point rate cut, not a 25 basis point rate cut. Shouldn't have been somewhat surprised. Well, guess what? The market kind of knew, and it was all priced in, so there wasn't a lot of movement outside of the 10-year going up, not down, because there's more confidence by the consumer in the long term, because the consumer is afraid in the near term of a recession. Even Jamie Dimon's fearful of a recession. I read you the consumer sentiment at the top of the show. Consumers are afraid of recession. So what happens? Those near-term treasuries go down. There's less confidence in them. But they have more confidence in over the long run, over the course of 10 years, that things will be better. So that drives the 10-year treasury up. It also drives mortgage rates up, not down. So interest rates are actually up since the Fed cut rates last week. In fact, some products have seen interest rate rises of 20 basis points or 0.20% over the last week, even as the Fed cut rates by 50 basis points. How is this possible? Here's how we knew the move was coming and capitalized on it and was able to tell you about it. The 10-year note, if you want to look this up, you can look it up by going to, I believe it's $T as in Tom, N as in Nancy, X. So that's $T and X. That's the symbol, ticker symbol for it. That has risen from 3.6% to 3.80% in just 6 days. And for those of you saying, well, Chris, what day is it when you're recording this? I'm recording this on Thursday, the 26th of September. And I believe it's actually a little higher today. I put that in the show notes a couple days ago. So probably in and around there. But trust me, that's where it was at whenever I wrote it down.